So welcome to Brookings. I'm Martin Bailey, the head of the Initiative on Business and Public Policy. We have a session today on, is there a liquidity problem? And we're going to start off with a speech from Stan Fischer. When I entered MIT as a first-year PhD student, Stan Fischer was in his final year. I guess that's a way of saying he's a little bit older than I am. He already had a reputation for a future leader in economics. He went on to the University of Chicago after MIT, and he quickly established himself as one of the best young macroeconomists around. MIT brought him back, and as you know, Stan became a legendary teacher, a star researcher, and someone that has influenced generations through his textbooks. He supervised such graduate students as Ben Bernanke, Olivier Blanchard, Greg Mankiw, and many others. They must have been tough to get through their PhD programs. Important policy positions he's held include First Deputy Managing Director of the IMF, Governor of the Bank of Israel, and now his current position as Vice Chair of the Federal Reserve Board here in Washington, where he was confirmed by the Senate in May of 2014. It's my great pleasure to welcome Stan Fischer.
Right. Has he censored me permanently, or what? Oh, he's back. Okay. Thanks. Well, good afternoon, and thanks, Martin, for that. The one you left out was the World Bank, which is where I started in this business. Anyway, it's always a pleasure to be at Brookings, and this topic is one which is around and about which people have different views, which are related somewhat with how much liquidity matters to them, to their business, and to their profits. I'm going to talk about liquidity first, what people say, what market participants primarily say about it, and what the evidence they bring is, and then go on and talk. So let me begin. Market liquidity is the ability to rapidly execute sizable securities transactions at a low cost and with a small price impact. Well, I thought I've been looking for that definition because I think, if I'm correct about Martin Bailey, we learned that from Tobin. Couldn't find it in Tobin, however, so I had to go searching around to find it, and I found it in the World Bank's, in the IMF Global Financial Stability Report. The U.S. The high degree of liquidity in U.S. capital markets historically has contributed to the efficient allocation of capital through lower costs and a mix of bank and market bank-based finance that supports the flexibility of these markets, and that combination is relatively rare. Europe is very much bank finance dominated. Now, regulatory changes may have altered financial institutions' incentive to provide liquidity, raising concerns which have been brought into sharp relief by several flash events. People even call them flash crashes over the past few years. At the same time, any changes in observed liquidity are also likely accompanied by other related changes, such as in technology. And a more complete assessment of these shifts is important when we think about the effects on liquidity of changes in financial regulations that were induced by the global financial crisis. So I'm first going to review some of the concerns raised by market participants and others about market liquidity, as well as highlight the challenges associated with finding clear evidence that substantiates these concerns. Somebody said as we were sitting next door that all the presentations seem to use the same graphs, but people draw different conclusions from them because they're not entirely self-evident. I'll then discuss whether the potential impairment of liquidity might exacerbate problems related to fire sales and leverage. And finally, make the case that any changes in market liquidity resulting from regulatory changes should be analyzed in the broader context of the overall safety of the financial system. And this perspective naturally emphasizes potential trade-offs between the possibly adverse effect regulations may have on market liquidity and their positive effect on the stability of the financial system. So what I'm saying is this is going to be, I'm clearly saying this is not a discussion where, as far as I can see, there is an absolutely clear conclusion that everybody who looks at the numbers is bound to reach. And those are things, the nature of papers in which you're discussing things where it's not entirely clear is that they're much more difficult to exposit, but exposit we will. So what is it that market participants complain about? Well, I've got four things. The first is the decline in dealers' inventory. And market participants talk about the decline in dealers' inventories as a possible source of decreased liquidity. And what you see in Figure 1 is that primary dealers' inventories of fixed income securities, which they use predominantly for market making, declined very sharply after the Lehman Brothers failure from about $1.3 trillion to about $800 billion, and they've since fallen further to about $700 billion. So it's about half of what it was at the peak. Now, this decline might be due in part to regulations such as the Volcker Rule and the supplementary leverage ratio, which are aimed at making the financial system safer and sounder. But they could also be caused by the changes firms may have made on their own, perhaps in reaction to having been involved in the financial crisis. Whatever the causes of the change, market participants have expressed a concern that the decline in inventories reflects in part a reduced willingness or capacity of the primary dealers to make markets, which may in turn lead to lower liquidity. But whether markets are in fact less liquid because of the fact shown in Figure 1 depends on the degree to which the decrease in their inventories affects their willingness to provide liquidity, and not more important probably, the extent to which non-bank firms such as hedge funds and insurance companies fill any lost market-making capacity. Second fact, the decline in trade size and turnover. Now, market participants often cite the decline in average trade size and in turnover. Turnover is the volume of trades relative to the total amount of bonds outstanding as evidence of reduced liquidity. Figure 2 shows that the average trade size in the corporate bond market has indeed declined since 2006, but has been relatively stable in the past 4 years. This is one of those charts that experts see much more in than I do, but that must be because I'm astigmatic or something. The average trade size has declined since 2006, But this decrease may reflect a number of factors, including changes in technology or the types and preferences of institutions engaged in trades, so it may not indicate a reduction in market liquidity. Certainly, the length of this trend, which is a decade, seems on its face more consistent with a secular trend such as technological change than with something caused by regulations which started coming into effect in 2008, 2009, and later. Now, there's also an interest in turnover that's not shown there. Turnover in the corporate bond market has declined as well, though this evidence is definitely not a definitive sign of reduced market liquidity because the decline is not driven by a reduction in trading volume, but is a result of the robust growth of the denominator, which is debt outstanding. Third, liquidity during times of stress. Market participants further express concern about the potential for market liquidity to become less resilient during times of stress when it is needed the most. And I think that's what frightens everybody. But evidence on this front is difficult to gather. Some argue that it's resilient, market liquidity is resilient, because financial markets appear to have functioned fairly well during recent episodes of high market volatility, such as following the Brexit vote or earlier this year, when oil prices were low and stock market volatility was high in the first few weeks of the year. Others argue that it's not a sign of resilience or, others argue that market liquidity is not resilient. According to a recent study, the cost of trading distressed corporate bonds appears to be higher now than in the recent past. This is a paper by Bao, O'Hara, and Zhou, all references. You can find references on the Fed website. So we're talking about the cost of trading distressed corporate bonds. The authors find that before the crisis, the cost of a $1 million bond transaction increased about 0.7% following a downgrade. But after the Volcker rule, the cost following a downgrade rose by 2.4%. That's quite a significant difference, 0.7% versus 2.4%. But this analysis is limited to episodes of distressed borrowers rather than to system-wide stress. And then the last thing that people point to is flash events. So recent flash events, such as the most famous, the sharp movement in Treasury prices on October the 15th, 2014, the rapid rise and decline of the euro-dollar exchange rate on March the 18th, 2015, and the swing in sterling on October the 7th, 2016, have led some to assert that market liquidity has become less resilient. And researchers at the Fed of New York have argued that spikes in volatility and sudden declines in liquidity have become more frequent in both Treasury and equity markets. The Commodity Futures Trading Commission also points out that flash events are more common now. Market participants suggest that the rapid growth in high-frequency trading in equity, foreign exchange, and U.S. Treasury markets, along with broader concerns about less resilient liquidity, potentially explains these flash events. Nevertheless, a report on the October 15th, 2014 event by the combined staff of the Treasury Department, the Federal Reserve, and market regulatory agencies found no single factor that caused the sharp swing in prices. So the evidence, the connection between flash events, I'm going to come back to this, between flash events and market liquidity is not straightforward. So let me review the evidence that we've started talking about. First, trading costs are low and remain low. Even though flash events appear more common, it's much too soon to say that a broad reduction in market liquidity has occurred. Figure 3 Figure 3 plots realized bid-ask spreads for investment-grade corporate bonds over time. That's the black line, the black dashed line, and speculative-grade corporate bonds, which is the red solid line. I think you wouldn't really find it very easy to say that liquidity measured by the bid-ask spreads is lower now than it was in 2006, before the financial crisis, and we're practically back, and we've been back. We were actually a bit lower in 2012, 2013. And alternative measures of trading costs, such as price impact measures, which attempt to capture the effect of transactions on market prices, follow a chart that looks very much like that. So transaction costs seem to suggest that liquidity has either improved or not deteriorated. There is some work currently, not quite complete, but that people are talking about, which suggests that measures of aggregate transaction costs in the corporate bond market may underestimate embedded liquidity costs. Two researchers, Jaewon Choi, who's at University of Illinois, a Midwestern university, and Yesol Hu, who is at the Fed. They looked at transactions in which dealers act as brokers rather than as intermediaries that hold assets on their balance sheets. So they're looking at people who are just basically the brokers rather than broker-dealers. And they argue that what one sees in the decline in the bid-ask spread is, in fact, that dealers change prices to entice others, counterparties, into the other side of a trade, so that the dealers don't have to hold the traded assets, and they make price concessions, which wouldn't have been made if it was purely a broker who was a broker-dealer who was doing it. And these lower the traditional measures of trading costs, making trading seem inexpensive, when in reality these concessions are fees the dealers pay to some investors for providing liquidity. And they argue that as dealer inventories have declined, this downward distortion to aggregate trading cost measures may have increased. Now, I can't quite figure out what to make of this argument because, you know, in almost every transaction where you're paying something for doing something for you, there are factors like this. The one we're all aware of is if you held a larger bank account, you're less likely to be charged for checks and things like that. And this is something of that sort. So I don't know what to make of it, but they've looked very hard and they found this result. And they do suggest that transaction costs may have improved somewhat in recent years. Second result, which I think is pretty impressive as opposed to that, is trading volume. Trading volume has risen remarkably, trading volume for bonds. You may ask, why is it that my slide moves first to the side and then comes back? The answer is that actually I have a blank sheet. Oh, you don't see it. I see it on the screen. Yeah, I have a blank sheet between slides because I don't like talking about something when the relevant slide isn't on the screen. So here's a relevant slide for trading volume. Trading volume in the corporate bond market has gone up remarkably after going down during the crisis. In 2006, investors trade an average of $12 billion a day. During the height of the financial crisis, trading volume decreased to $8 billion a day. But by 2009 already, volumes came back to the $12 billion a day, and they're now at $19 billion a day. That is a very substantial increase in transactions. So this suggests that to the extent that liquidity matters for the volume of transactions, at least what has happened to the aggregate can't have been due solely to a deterioration of liquidity. This slide is only for the corporate bond market, but there are similar patterns in the equity and treasury markets, which is to say that to the extent this is relevant to liquidity, this is evidence against the view that liquidity has declined markedly in the financial markets in which assets are traded. Now, what are the policy issues related to market liquidity? To date, I think on average we have to say that observed changes in liquidity do not suggest that shifts in liquidity are having a notable effect on the cost of trading. Nonetheless, the potential for liquidity to evaporate in times of stress deserves careful scrutiny, and that's what seems to me the most important of the aspects of a claim that liquidity has declined or concern that liquidity may have declined. The one area where policy concerns have arisen is related to the potential for fire sales in bond markets, which should compound the risks associated with leverage in the financial sector. Bond markets have grown considerably, and market-based finance has intensified over the past years, making market liquidity even more important. Now, here we're getting to more complicated stuff. In addition, mutual funds that offer daily redemption rights hold a greater share of bonds than investors who buy and hold. As you see in Figure 5, the share of investment-grade and high-yield corporate bonds held at mutual funds, which is the solid blue area, has hovered around 25 to 30% in recent years, up from about 15% before the crisis. Now, reduced market liquidity might exacerbate fire sale risks from leverage at financial institutions or from first-mover advantage at mutual funds. Leveraged institutions are more sensitive to changes in asset prices. Adverse movements in asset prices, margin calls, and higher haircuts may force them to sell assets to obtain cash and delever, affecting other market participants through declining asset prices and increased margin calls. In addition, leverage may closely interact with liquidity risk at mutual funds. Open-end mutual funds are characterized by the so-called first-mover advantage. Investors can redeem daily from the funds that hold assets that are less liquid, while liquidation costs are borne by investors remaining in the fund. If a decline in bond prices leads to sizable fund withdrawals, the first-mover advantage could accelerate redemptions and second-round price declines. In addition, investors may perceive leveraged funds that experience stress as riskier, possibly becoming more inclined to redeem from those funds. This situation could be worse than in the past if market liquidity deteriorates and dealers are less willing to buy and hold bonds in inventory to cushion the price decline induced by fire sales. However, thanks to recent regulation and supervisory changes, including higher capital requirements and stress tests, leverage at the largest intermediaries is much reduced relative to pre-crisis norms, and as a result, vulnerabilities from potential fire sale risks are less significant. From this perspective, a small reduction in liquidity from regulatory changes, even if present, which is not obvious, may be a reasonable price to pay for greater safety. And I'll now place changes in liquidity into the broader context of financial stability. It is possible that regulations aimed at correcting vulnerabilities in the financial system, like the supplementary leverage ratio, together with other factors, have altered the business model of dealer firms and thus have altered liquidity. While the evidence for a reduction in market liquidity is far from clear, let us for the moment accept this possibility and consider the potential effects on financial stability. Regulatory changes, even those that may have reduced market liquidity, likely have enhanced financial stability on balance. Recent evidence indeed points in favor of an enhanced financial stability. Regulatory capital ratios for banks and insurance companies remain high, which, as previously mentioned, would mitigate fire sales and their effect on the solvency and functioning of these institutions. Leverage at intermediaries is much reduced relative to pre-crisis norms, and gross leverage at hedge funds, based on the partial information available, has not changed much in recent years. Research from economists at the New York Fed shows that the decline in leverage, among other factors, has substantially reduced potential fire sale externalities in the banking and broker-dealer sectors. Thus, the regulatory changes appear to be having a positive effect on financial system stability, and these benefits may outweigh the potential costs of a possible reduction in liquidity. Regulatory changes are in train for the asset management industry, whose vulnerabilities have been under examination by the Financial Stability Oversight Council, the FSOC, and the FSB, the Financial Stability Board. The SEC has recently approved rules to modernize and enhance the reporting and disclosure of information by registered investment companies and to enhance liquidity risk management by open-end funds, including mutual funds and certain exchange-traded funds. The SEC has also proposed rules that would put new limits on registered funds' gross notional derivative exposures, enhance the requirement for asset segregation in derivatives transactions, and include new risk management requirements for the use of derivatives. So what do we conclude? Well, for my conclusion, I'd like to quote my colleague, Jay Powell, with this sentence: "Overall, liquidity is adequate by most measures in most markets most of the time. Bid-ask spreads," end of quote, "bid-ask spreads and price impact measures point towards liquidity that is good by historical standards, and we have not observed declines in market liquidity in recent episodes of high market volatility. Nevertheless, the market structure is changing, and trades in certain situations and in certain market segments might have become more costly. Also, flash events have become more frequent. They're probably almost certainly the result of changes in technology. And the dynamics of a system with frequent flash events are likely to become complicated. Moreover, some regulatory changes, for example, the Basel III liquidity requirements and the supplemental liquidity ratio, are only being phased in at this stage, so we don't know what their impact will be on liquidity. In light of these changes and the evolving structure of financial markets, it will be important to monitor and continue to analyze the state of market liquidity. And that's one of the reasons why central banks all over the place are setting up financial stability groups, and which, among other things, report on the state of liquidity. As we monitor, we should continue to emphasize how the evolution of market liquidity interacts with broader changes to affect the efficient allocation of capital and financial stability. And as regulators, we should always bear in mind the possibility that new financial developments could change the dynamics of market responses to unanticipated economic developments. Thank you very much.
Thank you. Okay, so you'll turn them on, or I'm on now, I think. So thank you, Stan. That was terrific. Let me ask you the first question, and then I'll hand off to Hal. So do you as part of the Federal Reserve System, do you feel you have all the data you need? I mean, obviously one could imagine, but do you think you have enough data or the data you need to determine whether there's a liquidity problem? And if not, is there data that you would really like to have that for some reason you can't get access to?
Well, you'd always like to have more data, so there is that. So if you ask what is it that I'd really like to know,
yes,
it's whether in a seriously stressful situation, we'll find ourselves with liquidity shortages which we wouldn't have found in the past. Because, and I'm looking at Don Cohen among others, we don't have the same lender of last resort facilities that we used to have. So that seems to me to be the point at which this issue becomes really quite critical. And I don't think we'll know until we go through.
So we don't want to wish ourselves in that situation.
So we have to do everything we can to try to make sure that that won't happen. That's why this exposition switched from liquidity to how stable the system is.
Right.
As I went along. And, you know, if the system is stable and if liquidity is a problem, and it's not a problem that is anything other than a result of structural, of institutional changes since the financial crisis, then you could rely on market participants to find ways of dealing with this liquidity problem. So that part, I mean, we don't see anything drastic that's happened to liquidity in the present situation. Whether it's slightly better, slightly worse, is difficult to say. At least we find it difficult to say. And so you turn then to how do we avoid having to do the real life test of whether we've suffered a large loss in liquidity.
Stan,
I think that feeds into your your bailiwick.
well, I could go there, but I'd like to
you
sort
want to go
of
somewhere different.
back up to the whole purpose of this conference is to discuss liquidity. Okay.
Right.
So why is it important? Okay. So let's talk about that subject in normal times and in crisis. So in normal times, why do we care about the liquidity of these markets? Why is it important?
You want the markets basically for the convenience of individuals who need to find themselves needing to rearrange their portfolios, and because the markets provide price discovery and other amenities that people need at any given time. So I think if you didn't have much liquidity, you'd have 2 trades a day. You go to a much smaller country, you realize that the size of the market matters, because in smaller countries the prices are much more sensitive to individual transactors and simply don't work as well as prices typically work in great markets like those we have or the British have or some few other countries
So
have.
if we didn't have liquidity, let's say in our own markets and the higher credit risk offerings like junk bonds, would this affect capital formation? And we worry about this in the equity markets, that we don't have enough liquidity in smaller enterprises, and that therefore that affects their ability to issue and the cost of issuance. Do we have the same concern in the fixed income market?
Well, yes, we would have. It's just another way of raising funds, and if you worry about it in the equity market, you can worry about it here just as much. So yes.
You mentioned, since Don Cohen's in the room, I won't call it the shadow banking sector since he doesn't like that term, but the non-bank sector, the shadow sector, if you like, that is providing some of the liquidity. So it's not all being provided within banks or within broker-dealers, conventional broker-dealers. So is that a dependable way to provide liquidity, or is there a sense in which, because we are relying on the shadow sector, that it's more likely that that liquidity will disappear if things are stressed?
Well, I mean, you sort of need to have a particular view of life to say that if we're, it's a sort of Murphy's Law of something, that it's because we're relying on it that we have to, that it could disappear. I think that our failures to deal with the shadow banking or the non-bank financial system is problematic in the sense that we don't know enough about it and we don't quite know how it's going to behave under stress. And in the end, we're relying on that. When we had the Asian crisis, the 1990s, the Fed, in the form of its chairman, was explaining to everybody the benefits of the spare tire theory of the financial system, which, the banks went down, okay, somebody else, some other non-regulated institution would take over that function and so forth. And we were supposed to encourage all these other countries to have many different types of institutions. Well, but the trouble with that is you don't really know how it works. You can sort of go around trying to plug gaps, trying to fix squeaks and things that make you nervous, but we don't have the data and we don't have the knowledge. Now you might say, what don't we have the data about? Well, hedge funds is one thing.
Right.
And probably, and that's quite a few $1 trillion, so it's not nothing.
So let me turn to the Fed's role in this process. What's the proper role of the Fed in providing liquidity to the markets or to the transactors in the markets, and divide that into normal times and crisis times?
Well, in normal times, the Fed is using the supply of credit mainly for macroeconomic goals, and the markets are working fine, and you don't have to think about them very much. Then you get to the situation, what do you do with individual institutions? And there the central bank has substantial difficulties in sort of trying to decide what to do with a small firm that's going to go down. If it's a small firm that's going to go down with no systemic consequences, I don't think the central bank should intervene. I mean, I do believe in moral hazard, because I've had lots of people come up and tell me, you are going to intervene, we know that. And, we didn't know that, but they knew that. So those are difficult. And then if it's a systemic risk, I think the central bank has to get in a serious way.
You think there's a moral hazard when somebody's a victim of a panic run?
To some extent, but if panic runs were a new phenomenon, you'd say, of course. But they're not a new phenomenon, and that should be one of the risky events that people take into account in figuring out how much liquidity they need, how much capital they need, and so forth. So it has to be something really very bad to say, well, this is just the sort of thing the central bank does. It should not be doing the sort of thing central banks do in that regard every 3 weeks. That's a bad way of running the system.
So let me just follow up on the normal times. We've been in this QE expansion mode. There's some people that have concern that, or think that all this liquidity that's out there is partially due to QE, okay, and that there would be concern about a contraction of liquidity if the Fed were to shrink its balance sheet as getting out of QE. How do you think about those issues?
All these things are matters of the speed at which you do things and the transparency with which you do them. If the world has been told that we will we will roll over our securities, the securities in our portfolio, until the process of normalizing interest rates is well established. Then they need to know that that's coming, presuming we will normalize, which I do presume. So I can understand that, and you could see, you've seen in the taper tantrum, the fact that although people must have known something was coming, they took positions in which, when it came, they were damaged. So that happens, but we've really got to be careful not to jump into every market disturbance of some size. We've really got to watch out and not let companies fail, not save companies just because otherwise they'd have failed. You need to do it because there's much more reason from the viewpoint of the system for that to happen.
It seems possible that there are a set of shocks that could come across the horizon that might be quite substantial. Brexit was somewhat of a shock. We could get another round of sort of euro concerns about the euro and a euro crisis. We could get some surprising results in elections, and we've had one or two coming up that have happened already. So given given these unexpected events of potentially quite large magnitude, the importance that the U.S. markets play in the global market, would there be a case for saying, actually, we don't just need the same amount of liquidity, we need more liquidity in our markets than we used to have, because we got the problems that these shocks may come along, and we want to get through them, and we certainly don't want to go into another crisis?
Well, on all these things, you have to ask whether the situation has gotten worse, and I think it's very hard to make a strong case that the situation has gotten worse. So if we're asking, should we be having as much certainty as we used to have, given that we've tightened up the system considerably, at least on the banking side, and we have a much more stable part of the financial system, I'd wish it applied to the whole financial system, which is more relevant to where Don applies his trade these days. Then I wouldn't accept that, but we've got this unknown of what the shadow means for us. We need to think very hard. And by the way, you don't have to give everybody more liquidity. You could just stand ready and know what your plans are for dealing with such a situation.
Let's see if we have some questions from the audience. And we have a microphone. Would you please identify yourself? Would you please make sure it's a short, to-the-point question and not, yes, so the gentleman on the aisle there.
Stuart Brown with Warren Capital. Since July, the long-term rates have risen 100 basis points. Short-term rates are high enough now all of a sudden that where we were used to negative rates, we're now looking at positive rates. Is that a slow-moving liquidity crisis? Is that the beginning of liquidity when the institutions all want to sell and there's nobody standing on the other side of the trade?
If that was literally true, you'd think about it. At the moment, prices are moving. Somewhere on that desk, I've got the data. We basically had a decline in short rates and a lot of rates of about the magnitude we're seeing being reversed right now. So I don't see us. Anyway, I'm not going to comment on when we will be ready to intervene, if we'll ever be ready to intervene and things like that. So, yeah, we have to take into account the sort of phenomenon you're pointing to. But I don't want to give more quantitative information than that, in part because I don't know what the answer to the question of when are you going to change policy is. And if I did know, I wouldn't tell you, so you don't know whether I know. and we're there. But I mean, what you say is something to look, that we obviously have to look at the moment. I don't see it as yet something that's terribly worrying.
Yes, I have a question. Yes, the lady in the back there, whom I recognize, but I'm not able to grab your name out of my head.
Okay, it's
Nancy.
Nancy Jacklin. Hi. You talked a little bit about liquidity in the cash markets, and what I keep hearing from the professionals is that the liquidity in the derivatives market is much deeper, and that it's much easier to hedge positions quickly or to take positions through the derivatives market than through the cash markets. And I wonder how you look at those two together in trying to assess whether we have a marketplace that's viable and won't be subject to some kind of emergency response.
Well, what happened in the derivative, everything goes back to day one, which is September the 15th, 2008. If you go back to that date, there were a lot of things in the derivatives markets which had to be fixed and which are being fixed. When they get fixed, we're making progress in that regard. And if the system continues to operate more or less as it seems to be at present, you never say anything is, yeah, we fixed that problem. I always say when somebody tells you that about the financial markets, we've solved that problem. Too big to fail is solved. You fire them because they don't know whether they've done it, and you'll never know until you have to deal with these crises. And so it's a very tough situation. But does it look reasonable at the moment, or will it look reasonable within another 6 months? Yes, I think so. Will I regret that I ever said this? There's some probability. There's some probability that's true.
But you're covered now.
Yeah.
But I think you're raising sort of a question of whether there's hidden liquidity here, that we're looking at these cash markets and there's liquidity in the derivatives markets. That doesn't seem to be integrated in much of the people's analysis. Maybe that's a data gap that we could try to close.
It could be, yeah.
Yes, question, the gentleman there.
Thank you. Martin Boer from the IIF. From the industry perspective, I was encouraged to see that the spreads are improving in the volume. We do often also hear that blocks are much smaller. We also hear that it takes much longer to trade. We also know that there are many fewer market makers now. So maybe also just building on Hal Scott's comment, when the QE slows down, when the rates normalize, we do wonder what that's going to mean, and we do wonder if we're going into a period which is going to be more dangerous.
Yeah, I mean, you're entitled to wonder. We're entitled to try to be prepared for dealing with such situations if they were to arise. And that's about as much as I want to say.
Yes, there's a question here. Again, please identify yourself.
Good afternoon, James Fischbach with McRavoy & Partners. Mr. Vice Chair, are you at all surprised by the dramatic repricing of longer-term yields in the U.S. over the last week and what that may mean for the Fed over the next 8 to 12 months?
Sorry, were you saying we were all surprised? Or?
Were you at all surprised?
Well, if you take the event, if the question is, were you surprised by the situation in the world on Wednesday, the 8th of November, versus where it was 2 days before, the answer is yes. If the question is, am I surprised that the interest rates rose that quickly? If you gave me the conditions under which it happened, not especially, but if you were to tell me, I can't separate that from was I surprised by the election results.
No, it's not a political question.
No, I don't think it's political. I'm just telling you that there is a big, I'm surprised by something that happened. There's no point in having an argument with the markets when this is their reaction to a set of events, which they could turn out to be right and they could turn out to be wrong. I mean, if you'd asked me this question about Brexit 3 days after or a week after, I would have said, well, that seems like a reasonable adjustment, and then boom, back it came. So I can't tell you.
Well, I think we've taken a lot of your time. Do you have one last question you want to fit in, or shall we? I think we've got.
I'm fine.
A lot of great answers and a lot of great questions from the audience. Thank you so much for coming.
Thank you, Martin.